Hello listeners, and welcome to the Montel Weekly Podcast, where we bring you the latest news, issues and changes happening in the energy sector. This week, we return to a subject not often broached on the podcast: oil. We have now passed the one-year mark since the start of the conflict in the Middle East. Threats of escalation are growing in the area. Israel has pledged that Iran will exponentially has been the price of oil. Why is oil trading at $80 a barrel with the tensions in the Middle East? I'm going to be speaking to Richard Bronze, who heads up geopolitics at global data and intelligence firm NG Aspects. But first, here's what our Singapore-based correspondent Luke Roshan had to say about the current state of the oil market and the key drivers going forward. So Luke, let's talk about the oil price. Now, if we compare what it was on the day Russia invaded Ukraine versus the 7th of October when Hamas attacked Israel, what does it tell us about the oil market and what's changed over the last couple of years?
When Russia invaded Ukraine, we saw oil prices surge to around $130 per barrel. It was a time of great uncertainty as Europe scrambled to secure energy supplies, as it was heavily dependent on, Russian oil and gas. You fast forward to October the 7th of last year, and the Hamas attack on Israel. The reaction to oil prices was around $80 per barrel. And despite the ongoing tensions and conflict, we've seen a relatively muted response, or the price escalation hasn't been as high as compared to when Russia invaded Ukraine.
Historically, geopolitical tensions like this would have had a big impact on the price of oil. Why is there no geopolitical risk on oil prices at the moment, Luke?
Despite sanctions and restrictions aimed at at limiting Iran's oil exports, it continues to find ways to get its oil into the international market. They may be selling it at discounts, about $8 to $10 per barrel, but it still works for them. It's still a critical source of revenue for the country, and it can't put this at risk. It can't shut down the Strait of Hormuz, because in order to sustain its economy, it needs to be able to market and sell its energy to international markets.
Many thanks, Luke. Well, I'm pleased to be joined now by Richard Bronze, co-founder of global data intelligence firm NG Aspects. Welcome back to the podcast, Richard. It's been a while.
It has indeed. The world has changed a lot, but it's really nice to be back speaking to you again.
Perfect. And Richard, I think, could we start by talking really about the price levels we're seeing at the moment? I mean, given what's happening, the escalation, the tensions, why are we trading at levels that, quite a long way below a year ago?
Well, I think we've seen markets that are really reluctant to put in any kind of meaningful geopolitical risk premium, even as you've had notable tensions between Iran and Israel over the course of October, and there are still real risks of escalation. I think the reasons the oil market doesn't want to respond as maybe historically it would have done is that when people look ahead to 2025, market consensus is that we're going to be in an oversupplied market. And when they look at how much spare capacity OPEC Plus is holding, and when they look at the outlook for demand growth in China and elsewhere, the view is that there's ample buffers, and so you don't need to be as worried about the potential for supply losses. Now, that may be a bit too relaxed an attitude, but I think that's certainly why we're not seeing oil prices as sensitive to geopolitics as they had been historically.
So I think we'll come back to each of those points in turn, I think, Richard. But so do you think then the oil is becoming less sensitive to the Middle East? And what's, you mentioned the other factors, but this is obviously a key hub both for the transportation and production of oil.
Absolutely. I think right now, the market feels like it doesn't need to worry about geopolitics. And you can see that in the response, not only to the situation in the Middle East, but even to the Libyan oil blockade that we had over August and September. There, we genuinely did lose quite a lot of oil supply over an extended period of weeks. And yet oil prices were moving downwards for almost all of that period. Now, to try and understand why is it the market's changed attitudes, I think we need to go back to 2022 and the early months of the Russia-Ukraine conflict. And there were real fears from pretty much everyone in the market that we were going to see a big loss of Russian supply because of Western sanctions. Now, that big supply disruption didn't materialize, and prices, which had moved up to kind of $120+ a barrel, came right the way back down as fundamentals weakened and Russian oil was redirected to Asia without significant disruptions. And I think that experience and that memory of, a big supply risk that didn't materialize and a big sell-off as a result has really shaped the attitudes of a lot of traders in terms of how much and when to price in geopolitical risk.
I mean, we are going to focus on oil today and the related geopolitics, but how does the oil market compare to the gas market here? Because, there are big fears, and we've talked about it on this podcast, about the risks of the Straits of Hamas being closed off and what that means for the transport of LNG in particular.
I think, ironically, the trend is moving in the opposite direction. Gas markets feel like they're becoming more sensitive to geopolitical risk. Now, again, going back to 2022, that does make sense, because while we haven't lost big volumes of Russian oil since the start of the Ukraine war, we have seen big drop in Russian pipeline gas flows into Europe due to sanctions and due to the shift in buying patterns. And that simply hasn't been redirected to other markets in the way that oil has. So we did lose a big volume of gas, and gas markets, I think, are much more alive to the possibility of geopolitical supply disruptions. We've seen the Houthi attacks in the Red Sea and the impact on transit flows through the Suez Canal being felt and showing up in LNG markets and LNG prices, and that feeding through to TTF and the other European hubs much more than, again, historically, gas markets had very little focus on geopolitics on a kind of month-by-month basis. But right now, it feels like the attention is almost higher in gas markets than it is in a lot of the oil market.
That's a very interesting development, because we're both talking about two fossil fuels that are very important in many sectors. Now, but it wouldn't be fair to say that the oil market is ignoring the risk in the Middle East, would it, Richard? I mean, it's still there is a possibility of huge escalation, and which then will pose some degree of risk going forward, will it not?
Yes, I think there is an awareness that there is a risk there, and particularly in the first week or 10 days after the Iranian ballistic missile attack on Israel, when there was a lot of speculation about whether Israel might strike Iranian oil production or export facilities. We had a lot of conversations with clients who were thinking about this, trying to assess the implications. I think the point that's critical is we saw oil prices move up $5, $10 a barrel, but from a very low starting point relative to kind of the last couple of years of pricing. Some of that increase returned or unwound very rapidly when it started to look a little less likely that Israel would hit Iranian oil facilities. But this premium, which was never that big by historic standards, started to unwind even before we actually know what Israel is going to do. Because it will still, at least as when we're recording this, we don't yet know what Israel is going to do. But I think there will still be a response. There is still a potential for a tit-for-tat, back-and-forth set of strikes between Iran and Israel that could disrupt oil facilities or oil supplies in the region. That hasn't gone away. It's diminished a little bit, but the market is trading as if it's very, very low probability already.
What's your view here then, Richard? I mean, there is talk, Israel has said, as I mentioned in the intro, that Iran will pay for its attacks and for those missile strikes. But, what's the likelihood of a strike on those oil installations and the nuclear facilities even in Iran?
I think it looks like that's relatively low in the first round of Israeli retaliation. We know, and there's been quite a lot of reporting, that the US has been really trying to pressure Israel to avoid striking oil facilities or nuclear sites because of the escalatory risks. And it seems like the Israelis will listen. But if Israel launches a significant strike against Iran, Iran may well feel it has to retaliate. It's already made threats against not only Israeli energy infrastructure, but infrastructure across the region. Now, you can debate how much Iran and its proxy groups can do that damage, but certainly I think the risks of escalation are going to remain until we see not only what Israel does, but how Iran responds in turn, and whether both countries can find an off-ramp as they did back in April.
Is there, we talk about a wider escalation. I mean, we're talking here mainly about Iran and Israel, but what are the chances, other regional powers could get drawn into this? So you have, obviously the big oil producer in the Middle East, you have the Saudis, the Qataris, also Turkey. What's the likelihood that the ripples could be felt a long way out, Richard?
Well, I think that potential is really there. We've seen Iran and some of its proxy groups make very explicit threats against regional oil infrastructure. There is a particular focus on the countries like UAE that have signed Abraham Accord diplomatic agreements with Israel, so they have much closer ties. We've also seen a lot of diplomacy between governments like Saudi Arabia and Iran, trying to emphasize that the GCC countries are not siding with Israel. They don't want to facilitate or assist in any kind of strike on Iran, and they don't want to get dragged into this. But this is a very combustible environment, and it's one where the crisis could quickly escalate and in quite unpredictable ways. It doesn't mean it will happen, but I think it is usually those kind of possibilities and that range of scenarios and uncertainty that really puts oil markets on edge. So that's coming back to our kind of starting point, is why it's quite interesting to see how quickly the oil price response has been fading and how little there is in terms of real movement higher in oil prices whilst all of this is still bubbling away.
Absolutely. And as you mentioned earlier, the contrasting response in the gas markets, which is also very interesting indeed. But Richard, I think, moving on from geopolitics and certainly the escalation, the tensions in the Middle East, what do you see? You mentioned some at the start of our discussion. What are the other key drivers going down? I mean, for me, one of the elephant in the room is China's oil demand, which you also mentioned earlier. Has that's weighed down prices? What really is the root of these kind of issues in China?
Absolutely. If we roll back to kind of the end of September, just before Iran's missile attack on Israel, what we really saw was an oil market that was mired in bearishness. There was a view that Chinese oil demand and global oil demand growth had been really underperforming throughout this year, and it was going to get even worse in the year ahead. There was also this really well-established view that non-OPEC supply growth was racing ahead of oil demand growth. So countries like Canada, Guyana, Brazil were all, and the US, of course, were all adding a lot more supply than the world needed. And that this was squeezing OPEC plus, the group's market share, and was pushing that group closer to a price war and a breakdown of discipline. Now, those aren't my views, or at least I think there's some truth in parts of it. Particularly, it's no denying that Chinese demand growth has been very weak this year. The whole global economy is not looking super strong. But I think that consensus had got incredibly one-sided. All the most bearish aspects and ideas were dominating. And that actually sets us up in a place where, as we head into 2025, it wouldn't take much for fundamentals to turn out tighter than many people are banking on, and that oil prices are perhaps pricing in at the moment.
So what do you mean by that, Richard? Could you explain a bit further? What could be the forces that tighten oil demand still?
So let's take China as a starting point. Oil demand growth has been negative for a lot of this year. That's incredibly unusual when we think about the last couple of decades even, of Chinese demand trends. But there are signs that it bottomed out over the summer. We've had additional stimulus announcements by Beijing. They haven't perhaps gone as far as many in the market wanted, but we are seeing green shoots in terms of Chinese demand growth. There's also been a lot of talk about substitution of LNG trucks for diesel vehicles, of EVs for gasoline-powered vehicles on the roads. Those trends are happening, but again, I think the market narrative has just got a little bit ahead of itself. And we quite often come across clients who think that Chinese oil demand in total will have peaked and maybe going to start declining sharply in the coming years. And I think that's not going to be the case. I think we're going to see it not returning to the kind of blowout growth in demand that we saw kind of earlier in the millennium, but we could be seeing it turn positive again. And again, in a market which is quite narrowly balanced and really prices at that marginal matchup of supply and demand, it only takes a few demand growth outperforming or supply growth underperforming to change the whole setup.
Here in Europe, there's a lot of talk about, the Chinese electric vehicles that have sort of been flooding the European market, undermining European producers. But what's the situation like in China? You sort of alluded to them there, Richard. But it's almost as if you think that the case has been overstated here. That the role of EVs in substituting for petrol-driven or gasoline-driven cars in China. What's the situation at the moment as you read it, and what would be the outlook for 2025 to 2030 in the country?
Yeah, I think it's the pace of that transition that's maybe being overstated. Sales of what China calls new energy vehicles have grown to become a majority of new vehicle sales. But that new energy vehicle category includes hybrids as well as pure battery electric vehicles. So it is a broader category, and it doesn't mean no demand growth or no oil demand growth. But it's also the case that new vehicle sales are not the same as fleet. A lot of the existing fleet on the road will remain on the road for years, and a lot of that will still be powered by fossil fuels. Now, that is gradually shifting, and I think by 2030, we'll probably be in a place where, though the electrification has accelerated and is starting to make a meaningful inroad into road transport demand for oil in China, that process is not moving at the same speed in every country and region, but also even within China. Petrochemicals demand, jet fuel demand, these are all big contributors to the overall total, and they are not turning over at the same pace or at the same point. So I think what we're just seeing is this desire to hold on to a narrative and almost accelerate it. So yes, there is a big and significant transition happening. Does that mean that Chinese oil demand is going to start declining in 2025 and rapidly thereafter? I don't think so.
That's fascinating, Richard. I think that's good to get that clarified. I think last week the IEA, the International Energy Agency, released a report where it predicted that OPEC needed to cut another almost or $0.9 million in 2025 to keep the market in balance. What are your thoughts here, and what on the impact that could have?
Yeah, so I think it's again interesting. We've talked a little bit about how demand growth might do a little better than expected. So let's talk about the supply side, starting with the countries outside of OPEC. The big contributors that everybody is talking about to non-OPEC supply growth, the US, Guyana, Brazil, Canada. Now, looking at this year, Brazil and the US in particular have really disappointed. Growth has been a lot slower. US shale investment by companies is slowing, the rig count is slowing, production is still growing, just not as much as people had assumed, and the trends point to a further slowdown. In Brazil, it's been even more dramatic. Projects have been delayed, maintenance and unplanned outages and workers' strikes have been all taking a bite out of that growth. And yet, when you look to what does consensus expect for 2025, It's that these countries are going to roar back to rapid supply growth, and that's going to be a big factor in why we have too much oil in the market and more pressure on OPEC+. So where is the balance? I think it's just to say there is more uncertainty about the outlook for Brazil. We've certainly been trimming our expectations for how much supply will grow. We think we allow for it to do better than it has done this year, but that still will be a lot lower than many of the views out there. And the last thing I think that's worth thinking about is, yes, like the IEA, we think that our balances will be oversupplied next year, meaning there'll be more supply than demand on average over the year. But that factors in OPEC Plus plans to unwind some of their cuts, so to start increasing production. And they still have the option to slow that down, to pause it. They would rather bring that supply back, but I don't think they're going to do that if it's clearly going to crash the oil price. The starting point is going to be a couple of years in a row where the market has been undersupplied and we've been reducing global inventories. So there is actually some space for more supply, to have a small oversupply as long as it remains in check. And that, I think, is what OPEC Plus will really focus on. Not the day-by-day movement in the oil price, but actually our global inventories remaining low by historic averages, by the average of the last 5 years. That is, we understand, the real measure that they want to focus on, far more than perhaps whether different agencies think the market is going to be oversupplied, or what is the prevailing narrative.
So you say you can expect some or OPEC Plus to wind down those production cuts and supply more, but not massively so, but in small increments, if you like. We're not talking small, I suppose. We're talking million barrels a day, but you know what I'm saying. But
they have plans to gradually introduce that oil back into the market. They've already pushed those plans back by a couple of months. I think that within the group, there are clearly a lot of countries that would prefer to make a start because it would allow them to produce and sell more oil. They'd hope it would generate more revenue. But I think the group as a whole still has some flexibility. There's a lot of, there's a widespread view that the OPEC Plus is losing all of its agency or control over the market. I think it faces a challenging environment this year and heading into next year, but it still has quite a bit of flexibility over what policies it decides, just in terms of, does it start to increase and does it continue to increase production? So it doesn't have to make further cuts to have still some sway over where we end up with oil balances next year.
You mentioned the US as well, Richard. Now, I mean, production there is close to record highs, isn't it? Or at record highs, even 13.4 million barrels a day. It's also weighing on prices. How do you see that panning out next year, particularly in light of an election that's happening in a few weeks?
Absolutely. So I think the US growth story over the last 10, 15 years has been absolutely incredible. And US shale production has totally altered the dynamics within the market, because not only has it been very rapid to grow, but it's also proved pretty resilient to periods of lower prices. But that growth engine is slowing down. And one of the things that's really noteworthy over the last sort of year or two, we've had quite a lot of M&A activity, bigger publicly listed companies buying those very small, aggressive investing private shale operators. Once they've been bought, the rate of growth in those smaller companies that have been purchased tends to slow down to match the lower average of the bigger company that's acquired them. So you can view that as kind of the small companies, really pushing their inventory, marking themselves up to be as attractive as possible to a buyer. But as that acquisition activity takes place, it actually slows down the volumes of new supply that have been coming online. And I think that's going to be felt along with the lower rig counts and the slightly more cautious attitude against a lower price outlook over the year ahead. On the politics, clearly, we've got a very close and contested election. We've got one candidate who talks about being very in favour of the US oil and gas industry. And we have another candidate who, 4 or 5 years ago was promising to ban fracking, but has really changed attitudes. I think the truth is what goes on in Washington has a much smaller impact on the pace of US production growth than the oil price, than the attitudes of the companies that are operating and investing, and the technological advances that take place. Politics can matter at the margins, but realistically, there won't be huge differences in actual policy between the two sides. It will be much more about tone, and I think it won't be the driving force. We are at or near record highs of production under a Democrat president, and I think we'll see new records whether we have another Democrat president or a Republican president next.
That's very interesting. Again, Richard, so that really, whatever happens, it will have very little impact on the supply and demand dynamics from the US and the wider oil market. I think that would be correct in a correct assumption. Or
I think the place where we could see more impact is in foreign policy, and I think this has been the case. So certainly on sanctions on Iran, I think we would see a Trump administration taking a much tougher stance than a Harris administration or than Biden has over recent years. I think conversely, we might see Harris pushing a bit harder on Russian sanctions enforcement than perhaps Trump would, although I don't buy into the idea that Trump would immediately end the war in Ukraine or immediately reverse sanctions on Russia. So I think there is a lot of campaign rhetoric to sort through, but I think it's in foreign policy and probably in trade policy that the US election will have more impact on oil markets than it is around the US production regulatory space.
Yeah, so more globally rather than domestically. I think that would be maybe a good clarification there, Richard. But in general, in terms of the energy transition, if we're seeing an oversupplied market potentially in 25, 26, I don't know, $80 a barrel isn't exactly low, but potentially could become a little bit lower. What kind of impact does that have on the green energy transition more generally?
It's a really good question. I think there's a school of thought that what you want is a really high oil and gas and coal price, because that will create a strong economic incentive for consumers to find lower priced, more stable alternatives. I think there's also been a big debate about energy security since the Russia-Ukraine conflict took off. And there is an argument that, domestic renewables, even nuclear, provide greater energy security than reliance on imported oil and gas and the exposure to the global market that they bring with them. But probably the biggest driver here, I think, for the energy transition will be about policymaking at the national level and at the global level. We're going to have COP29 coming up quite soon. A lot of big debates and big issues still to resolve, particularly around financing and the investment that needs to go into the transition and how to secure it. But you also need to see policy that doesn't just focus on discouraging new oil and gas supply, but actually really finds smart ways to encourage shifts in consumer behavior. Because a lot of what I think we've seen is more pace and development on this renewable supply side, on alternative supply, a big slowdown in willingness to invest in oil and gas projects, which will probably become more so if the outlook for prices is low. But quite often a stickiness or a slower appetite from the consumer to embrace those alternatives. And if you get a mismatched timing between the supply shift and the demand shift, I think that's when you can have really uncomfortable and disruptive transitions. It's not an easy task, and I'm not pretending I would want to be sitting in the halls of Washington or Whitehall and trying to make these decisions. But I think that's critical. We don't let the supply timelines get too disconnected from the demand timelines.
Very, very important point there, Richard. I think, a fascinating discussion, Richard, as always. So thank you very much indeed for being a guest on the Montel Weekly podcast.
I've really enjoyed it. Thanks for having me on.
And thank you, listeners, for tuning into this episode.